Merry Christmas, Happy Holidays. Um, Kevin and I tonight wanted to jump on to discuss basically a 2025 recap, a little bit about the current state of the economy and moving forward into 2026, what some of our game plans are going to be. So I'm not even going to do any pleasantries here. I'm just going to dive right into it. The first thing I would want most of you guys that are here that are interested is to take a picture of my screen. Let it be a screenshot or a picture with your phone. And I would ask that you save this picture and see it whenever you want to question your existence. I'll just wait a minute so you guys can all take a picture of it, and then I'll begin, because all of this is related towards everything that I'm going to talk about, which I created a nice little presentation for. So if anybody has any questions, I would I have a tendency to not read the live sessions chat. I always seem to look at the main chat, but I can see that Eternal Learner just posted it on the live chat. So let's dive right into this. The four most important things that you need to learn in your language are going to be the different quads of the economy. Number one is the Goldilocks. Number two is reflation. Number three, stagflation. Number four, deflation. Goldilocks, quad one, is very simple. Growth is going up, inflation is going down. Everything is booming. Reflation, that's when growth is going up and inflation is also going up. Not a great situation, but still better than stagflation, in which growth is slowing down and inflation is going up. That is a state of economy that you don't want to be in. And then, of course, you have deflation, which is the infamous growth is going down and inflation is going down, right? You always want to have a tendency to be in the Goldilocks scenario. And you have to look at the economy in different sectors based on seasonality and quarterly, right? So is this quarter a Goldilocks quarter? Is this quarter a reflationary quarter? Is this a stagflation quarter? Is it a deflation quarter? All of these things are a substantial part of understanding the greater market dynamic, which is what we're going to go over right now. First and foremost, I want to talk about the most important index that exists to me in the world, which is the S&P. And what we're going to discuss today is the S&P versus the macro reality of 2025. A year where inflation stalled, labor cooled, housing rolled over, leading indicators weakened, yet the S&P continued to trade near all-time highs. This brief lays out the divergence with monthly tables and cross asset confirmation. So, as a guy who is a predominant bear and has traded the market on fundamentals for 20 years, this was a culture shock to me, or a reality check, better yet, because everything in the market indicated to me that we were going to have a terrible year, yet we set all-time highs. And why is that? Well, let's look at some of the terrible news. CPI, month over month, continued to go up, continued to go down. It fluctuated. It never went towards that 2% that we asked for, but it stayed in the threes, stayed in the mid threes. And we can see that from January all the way to November, we kind of maintained CPI at where the year was trending. Still not great because it wasn't the 2% that we had asked for. The unemployment rate stayed above 4%. We were at 4.6 in November. Terrible number. We could see unemployment was ticking up and down, up and down, up and down, But right when we got to Q4, we started to realize that we were going to have upticks in unemployment. The labor market cooled gradually rather than breaking. And it's really important that people understand that. It cooled rather than break, which was something that we were all expecting. We wanted the labor market to break, and it didn't. Unemployment did drift higher across the year as hiring momentum slowed down. And we saw that across the board. Everyone has talked about how hard it is to get a job. You send out 2,000 resumes, you don't get any responses. But people were still getting hired. It just seemed that it was at a slower rate. Based on the catastrophic reality that was being sold to us, we would thought that unemployment would be at 5.5%, but it never got that far. So was the labor situation oversold to us? Was it something that the market was using as a weapon to push the market down because everyone hated the market? Well, let's keep digging. Housing prices rolled over. The average price of a home dropped tremendously throughout the year. Everyone was talking about how the housing market was softening. Housing markets were getting weaker mid-2025. Affordability pressure was on. Elevated mortgage rate constrained the demand. But did the housing market collapse? It didn't. Was it in a tailwind? Did it become a systematic problem? No. So we kept preaching CPI, that it was running hot. We kept talking about that the unemployment rate was going to go through the roof. We talked about the housing market completely collapsing. None of these things have happened so far. How much more bad news can you ask for? Because just 2 out of these 3 in itself would make you think that you would have a down year in the market, right? Every single leading economic indicator was telling you that there was a deterioration in 2025. But it's really important that we understand something. And it's right down here. The LEI deterioration remained persistent through most of 2025. The type of forward signals that typically supports a defensive posture. That backdrop is what made the S&P grind higher so painful for macro bears. So if we go back really quick and we talk about a hot CPI, we talk an increasing labor market, an increasing unemployment rate. We talk about a drop in housing prices, but still unaffordable. And we're seeing that all leading economic indicators are telling you that we're weakening. I mean, I'm a bear. I need to be short. But let's not forget that every single piece of bad news still made the S&P grind higher and higher, which is why it's so painful to be a fundamental trader and be a macro bear and watch the market slowly grind. Gold and silver went to its all-time highs. You have 5 things that the market signaled that said to you, this needs to implode, everything is going to collapse, things need to fall, we're going to die, the zombies are coming 28 days later, 28 years later, everything is real, people are going to kill each other on the street. We went from gold being at 2,500 an ounce to almost 4,500 in probably the shortest period of time in both micro and macro gains in any type of underlying. The only thing that you could even come close to this would be crypto, right? And silver, for God's sake. Something that no one ever paid attention to silver. I mean, who cared about silver? So once again, the S&P versus macro reality, right? You have CPI going higher, unemployment ticking higher, housing prices are rolling over, leading economic indicators are collapsing, gold and silver are popping, silver futures reached record zones. Metals have ripped so much that it almost makes it impossible for anyone to say that it can go any higher. But who are we to say that there isn't more room up? If we're looking at things from a fundamental perspective, one would say that there needs to be a pullback. But when do fundamentals stop working? When do technicals become the leading edge for the market? The reason I bring all of this up is because I want you to have a final takeaway before I move to the next part of the presentation. 2025 wasn't bullish because the data was good. It was bullish because the data wasn't bad enough to force deleveraging. Macro stayed ugly, but not violent. And the metals tape reminded everyone that inflation and currency credibility were still live issues. So, thinking about what we read in, The Economist, Financial Times, what you see on Bloomberg, what you see on shit at CNBC, we've entered a state where the data isn't bad enough. So therefore we can grind higher because it's just not bad enough. Meaning, has our expectation for catastrophe been risen so high and so out of the atmosphere that if we don't even come close to it, it's therefore a good thing? Because I come back to what I said before. If we look at quads and we talk about Goldilocks being a period for growth up, inflation down, reflation, growth up, inflation up, stagflation, growth down, inflation up, and deflation, growth down, inflation down, where did this year fall? Was it a Goldilocks? Was it a stagnant year? Was it a deflationary year? Where do we fall in the whole metric of it all, right? Because ultimately, when you look at this chart, it goes completely against the fundamental and macro perspective of where the market should be. So if the market is now ignoring the fundamental idea because it's just not as bad as we thought it would be, is it safe to say that we've created a negative barometer that is now unattainable? Therefore, a collapse is almost impossible? Has it purposely been done? Well, let's reference some things that would make you think that things are terrible. But again, they're just not bad enough. Credit stress. Since the day Kevin has met me, I have talked about the impending doom of the credit collapse in this country and the possible implosion that will happen within the next 3 to 5 years. Well, while headline economics data softened gradually, credit metrics deteriorated more visibly through 2025. Credit card delinquencies ticked up quarter after quarter after quarter after quarter. How is it that with delinquencies in the credit market ticking up at such substantial rates, it didn't matter? One of the things that I always like to think of is that if credit card delinquencies climb steady throughout the year, right, you're going to think that there's going to be a rollover factor into the continuing year, because defaults don't happen momentarily. They're entrenched, similar to inflation. So, did credit card delinquencies not go high enough for us to get worried? Maybe. Consumer credit loans. In a country that revolves around credit, where no one purchases vehicles blatantly with cash, we're seeing the auto delinquency rate continue to tick up. I want to show you a chart, which is, for the most part, shocking. And I just have to see it really quick. These are all all this data is available on TradingView. You just have to know the ticker for it to get all the economic data. But I'm trying to find the amount of auto loans. There you go. We have $501 billion worth of auto loans from all commercial banks. This is kind of lower than it was, but it's still a scary number, right? Sure, granted, it's not 520, right, or 523, but 501 is still a lot. Look at how much we've gone up in borrowed money for automotive loans. So if we're having delinquencies go quarter after quarter tick up, it's only a matter of time before some of these loans start to default. And really, we start to see this number come back down, right? Because what happens is the auto loan market will get tighter. But did it get tighter? Well, based on this data, you would assume that they would have tightened up the amount of leverage that they would have given out, right? But they didn't. They just kept on giving out more and more loans, even as delinquencies increased. Okay, cool story. Corporate credit defaults. A lot of people don't really understand what corporate credit defaults are, but the name itself literally defines it as exactly what it says. These are companies that are either declaring bankruptcy or have gone negative on a substantial and/or portion of their debt. So, for example, they, just using a very simple term, like let's say they default on their American Express, but they don't default on their MasterCard, right? So corporate credit defaults started going up because there was a lot of companies that just popped out of nowhere in this crazy growth cycle that we had that weren't generating any revenue. that were trading at 200, 300, 400 times EBITDA for no reason. Or selling themselves for 200, 300 times their EBITDA, right? They weren't worth anything. Or for that matter, had a 700, 800 times 700, 800x PE ratio. Nobody was paying attention to the foreclosure market. I was, because I'm a real estate broker and I run my own firm. Foreclosure rates started ticking up. But despite the fact that foreclosures were ticking up, they were still systematically lower than usual. Credit conditions softened through 2025, particularly among rate-sensitive and lower credit quality borrowers. Well, we all knew that was going to happen. Because if you're old enough to have lived in 2005, 6, 7, and 8, which I am because I'm going to be 43, there was a time 2 years ago where anybody could get a Quicksilver card by Capital One for $500. Does everybody remember that? Everybody was getting notices for that. Everybody could get a Discover card. And they didn't even care. They were just giving them out like free money. Student cards were being given out like if it was nothing. So, of course, there was going to be a lot of lower credit quality borrowers that were going to default. But guess what? It still didn't crack the system. So we had talked about consumer auto loans and how their delinquencies have been going up. Well, here are the 90+ day delinquencies. However, it wasn't catastrophic. They did tick up higher, but it wasn't something that was, holy shit, everyone's defaulting. Mortgage delinquencies, which are very different than foreclosures. These are people that are behind. Was it catastrophic? It wasn't, but it did tick up. Here was a foreclosure start rate. The foreclosure started to, they increased modestly, but still at very low levels. But what they fail to tell you is why the foreclosure rate is still at a very low level. Because it's taking anywhere from 6 to 8 months to begin the process for foreclosure. That's how backed up the courts are. So this number looks great, but what happens when it starts to really pick up? I come back to this first page. A year where inflation stalled, labor cooled, housing rolled, leading indicators weakened, yet the S&P 500 continued to trade near all-time highs. And then I come back down to this. It was bullish because the data wasn't bad enough to force deleveraging. So when we talk about recognition of patterns, recognition of trends, recognition of where the market wants to go versus what the data is telling you, the question itself becomes, have the macro fundamental traders, have they become a thing of the past? Have economists, have market participants, have they thrown Armageddon so out of this world and so catastrophic that if we don't come near that, its line go up? Or is it just that the macro bears were too early? Today, before I finish this presentation, I send it over to my mentor, Tom Layton, who most of you have heard me talk about, who used to be the head of UBS's two-year government bond department from 1983 to 1996. One of the biggest bond traders in the world. My neighbor and my mentor and dearest friend. Also a friend of Kevin. And I sent him this and he read it really quickly before I turned it into a PDF. And he came to me and he said something, because, the majority of bond traders, they're all apocalyptic. They all want, the giants to come out from the mountains and kill humanity. Unfortunately, I was trained by guys that think like that. Therefore, that's why I always lean short. But he said something which is very true. And he quoted Tom Lee on an interview. He says, no one ever became rich being a bear. And God damn it, that hit me like a ton of bricks. Because it is true. No one has ever become rich betting on the collapse of a government, betting on the collapse of a dollar, betting on the collapse of any type of underlying. Granted, there are some people that have become very successful at it, but of the 100% of investors that exist in the real financial world, right, that work on Wall Street, that work on Bowler Street, that are sitting in incredible trading desks in Chicago or Hong Kong or London or Singapore, what do the shorts account for? What do they account for? Maybe 1%, maybe 2% of the market participants? But for some reason this year, they had the loudest voice. And I have accepted the fact that even though they might be right, they were too early. And I'll tell you something. If there's one thing that bulls hate, is a couple of flies flying around, disturbing them from eating. So the point of this lesson, because I have 30 seconds before Kevin takes over, is that for us as day traders or as portfolio managers, because everyone is their own portfolio manager if you're investing in your Roth or your IRA, sometimes trying to be the smartest guy in the room is what kills your account. Because instead of me being up 13.5% on my Roth for the year, I should be up 25. And it wasn't until the latter part of this year that I finally flipped my perspective. Moral of the story is, let's not let 2026 be another situation in which we let the news, we let the data, and we let the perspective of a few take away the vision of what's really happening. Because I'll tell you this, we slow grinded this year to the top in ways that I've never seen. And I know a lot of professional shorters, and I've never seen them lose so much money like I did in 2025. So going into 26, the lesson that I take away from this is that sometimes the fundamentals are flawed. Sometimes the leading indicators are flawed. Sometimes what's being put in our brains because of that data is flawed. Let it be because it's not as bad as we thought it was going to be, or because it hasn't gotten as bad as it's going to get. So rather than trying to time, let's follow the trend. Because if there's one thing that I'm not going to do again, is try to time a collapse. Because I've done it twice in my lifetime, and both of those times I failed. So I end it with this. The year was bullish because the data wasn't bad enough to force deleveraging. And now I hand it off to my buddy Kevin.
You guys can hear me, right?
Mm-hmm.
Yeah, I mean, JP pretty much hit on the spot. He's way more better versed in fundamentals. One thing I also wanted to also mention was the fact that sometimes you won't always see the stock market and the economy always correlate hand in hand. You need to also realize, like everyone needs to realize that um, the economy is not always going to be shown through stock market, right? Like sometimes, obviously, when COVID happened, obviously we had the market dump right in 2020 and in 2022, but there's also instances, even though JP just showed you everything that he showed, right? Like you saw that we're technically in a shitty um, environment, economically speaking, but we're also going up, right? Another thing that's also important to look at, and you could also see this in previous market crashes as well, prior to them, was the fact that you also need to focus on the profit margins for companies. If you guys obviously have been paying a little attention to news or a lot of attention to news, it's usually Nvidia, AMD, Oracle, or whatever other, tech company that's close or related to AI making some sort of deal, right? So these guys are just in a circle, insert the next word there, right? They're just in a big circle doing each other and they just pass the money over and over again. And on top of that, you could also see these initiatives that these companies are taking. For example, we've heard Microsoft, Snapchat, Google, Amazon, all these companies have also been laying off a lot of their workforce. People might think, especially if they're new to trading, oh, if they're laying off their workforce isn't that bad because then more people losing, their jobs and that's bad for the economy. That is bad for the economy, but it's not bad for companies. You have to also remember when we're trading on the stock market, we're trading companies. We're not trading purely the economy. Now, does the companies follow the economy? Yes, they do in most times, but you also have to realize sometimes it's also directly important to the company that you're trading. That's why, for example, the S&P 500 and Nasdaq have been at all-time highs or close to all-time highs because the profit margin for these companies are increasing. Even though consumer spending is, almost at an all-time high or it is at an all-time high, uh, you still have these companies that are relieving their workforce and attempting to replace it with things such as AI. Now, regardless of the fact that a lot of companies are already regretting that decision, there still is the fact that you're looking at the potential for a higher profit margin because there's less people you have to pay, right? These companies, the way they're thinking about is, hey, instead of paying five people 300 grand in total, why don't I just build or why don't I incorporate an AI, which is going to give me a yearly cost of 50K? That's just an example, but that's just like, for example, a 250K saving. So that's also one thing, and why a lot of these companies are just squeezing. One company I want to bring into light is also MU, right? MU, why is MU speaking? Well, Micron Technology creates and manufactures a lot of the RAM, right? And if you guys, for example, are enthusiasts in building computers or you just know tech a lot, you guys know there's a huge RAM shortage. And the reason why that's the case is because of this whole um, AI thing going on, right? And JP, if you actually don't mind streaming again, because all our streams are full. But all these AI data centers and everything that's running this AI need more storage. So they need SSDs, they need RAM. So that's why MU has been squeezing like crazy because the supply of RAM is so less, but the demand for it is very, very high. So there's also these individual companies that are also causing this whole squeeze to the upside. And then you look at Nvidia, the past what is this, 3 months now, 4 months, it's done absolutely nothing, right? Well, that's because eventually market leaders, because Nvidia is a market leader, have to take some time to cool off. Now, the way a market continues going up is if you have these exchanges of the market leader cooling off and the other, you wouldn't say leaders, but the kind of like for example, the Mag 7, the rest of the Mag 7, or Batman, whichever one you follow, if those pick up steam as well, right? So even though Nvidia is not performing that well, if you go to Microsoft, it didn't perform that well either. But if you go to Amazon, Amazon's trying to pick up steam. Apple's been picking up steam. You saw Micron as well, even though it's not really part of the Mag 7. I believe Avgo was also performing really well for a short period amount of time. You have Oracle that had a perform amazing earnings before it just completely collapsed because it's a shitty company, but that's just my opinion. But it also depends on the company you're trading, right? So you always want to make sure you know what you're trading, whether you're swing trading, day trading, it's very important. If you trade primarily zero DTEs, you need to know which ETF you're trading. If you're trading IWM, you're trading small cap stocks. Now, small cap stocks flourish when loans are easily accessible, right? Versus when loans are not easily accessible, that's when small cap stocks don't really perform that well, right? So you need to kind of have a good, not a good understanding, but a basic understanding of which usually flourishes during each time. Like IWM will flourish when the interest rate, for example, drops, right? Companies that are in the Nasdaq, which is QQQ, those will do well also on the same low interest part, but they have a lot more, I would say, strength to it compared to small caps. And then the S&P 500, which is SPX, right? This is a combination of many stocks, right, over across many sectors. So that's why this has been performing well, because even though we saw some of the tech stocks like Microsoft, Nvidia, they were not really like climbing up the ladder, but the S&P 500 is. And the reason why the S&P 500 is because there's other sectors that are starting to catch up steam um, at this current moment in time, which is where we're going to be leading into next, right? So what's important about this is the fact that you need to know, even if you do something as simple as trading zero DTEs, you need to know which ETF to trade during a certain time. If you start to see tech sectors and tech stocks kind of slowing down, that means you probably would want to focus less on QQQ and trade more SPY. And the simple reason is because when things start to slow down and they lose steam, the intraday movements are pretty small, which basically means you're going to be in a lot of range days, right? Versus when it's catching up steam or it's continuing with steam or momentum. I don't know why I'm saying steam, probably just because I came out of the shower an hour ago. It's going to have bigger intraday moves. So you're going to have a lot more bigger trends, which are usually profitable if you trade with the trend, right? So that's also something very important to notice and keep an eye out for. Now, when it comes to sector rotation happens not all the time, but very, very frequently. For those who don't know what that is, all it simply means is money goes from one sector, a sector is like technology, to another sector. And another sector, for example, let's say being healthcare, right? The reason why this is because eventually things just go up straight in a line, right? Let me give you my beautiful drawing for those who have two brain cells just like me. All right, so things go up in a line and eventually they have to cool off, right? A good example of that is NVIDIA. And during this cool off time, I know me and a lot of people, also money managers as well, they want to keep their money active, right? They want to make sure that they're making efficient time of their positions and their capital usage. So instead of being stuck in here, what they'll do is they'll take some of the position from, let's say, NVIDIA, and then move it over to a stock that is starting to pick up momentum, right? So let's say we get a healthcare stock that's doing this, and it starts picking up, right? And then you get this falling wedge. You break out of the falling wedge, you bounce off of support, and this is catching momentum. So, like, okay, meanwhile, this is cooling off and there's less momentum on this. Let me put my money into healthcare, for example, right? So that's why it's very important to know which sectors and how to kind of figure out which sectors are like performing really well. An easy way to look at this is a stock heat map. Now, since 99% of you have what's it called? Trading View, you guys can easily be able to access this very easily, right? All you have to do is just let me delete this. You just press a new tab. You scroll down here to heat maps. You choose stocks. And I personally like changing it from S&P 500 index to all US companies just because this gives me a lot more information to look at. And it might seem like a lot, but trust me, I'll make it very simple for you to look at. All you kind of want to be paying attention, all I want to pay attention to is a few things, right? Technology and technological services, these are kind of, you could, if you just want to make it simple, you could kind of view this as one. Finance is different. Retail trade is somewhat different. And in health, for example, health technology, consumer services, transportation, these are completely different. Not completely different, but they are different from technology, right? And what I mean by different is they move differently. They don't always move at the same velocity as the technology sector, right? So what I mean by that, when we're in a bull market, most sectors will be bullish, but some sectors will be more bullish than the others. When you're in a bull market, you'll always be in a risk-on environment. That means you're going to see technology, right? Because technology will, what's the hype right now? AI, quantum computing. So that's all in technology, right? So that's where you see that, like, pumping up very hard. Versus health technology, it's not fully the risk on kind of sector. So it's performing, but it's not performing as well. But again, going back to what we talked about before, what happens when you start losing steam in the technology side? That's when they want to move over to health sector, right? For example, talking about that, you guys saw how Nvidia has just been doing bull crap, right? So has Microsoft. Microsoft has not been doing anything. So where's this money going? If you were paying attention to the stock heat map throughout the month and last month, you'll see a lot of the days the health technology sector has been very, very green. And that means if you look at majority of these stocks that are in, especially the bigger ones like Eli Lilly, Johnson Johnson, AbbVie, MRK, which is Merck, you look at these charts, they are way different than what Nvidia and all the technology stocks are, right? You can see Eli Lilly has been soaring phenomenally, right? After breaking out of this like freaking almost 1 year bearish channel that it's been in. Johnson Johnson has also been squeezing as well. What's the other one? AbbVie, a little bit more volatile to the upward and downward, but you could see
Fair
it
enough.
was very bullish and it started creating somewhat of a pennant, right? And MRK is the laggard out of the bunch because it's been kind of basing and now it's starting to break out. So it's very important to realize, okay, where is the sector rotating to? Because if you're starting to see health technology performing a lot better, if you're simply doing zero DTEs, that might tell you that, hey, maybe instead of trading QQQ, I might want to trade SPY or SPX because there's a bigger probability that intradays are going to be bigger or the trends could be a lot larger, which of course theoretically increases your profitability, right? That's a very important thing to look at. A lot of people think like, oh, fundamentals, sector rotation, all this stuff is bullcrap. I just trade zero DTEs. But you want to make sure you're not just trading a dump. Just because you're lucky, 1 year or 2 years doesn't mean you'll be lucky the rest of the years, right? You have to make sure you know some basic things to know what is good to trade. Not one set of things or two set of things is going to be great to trade all the time. For example, you guys see me trading Tesla a lot right now, right? Well, that's just because Tesla has been performing really well, and it's been, even though it's been somewhat ranging towards the upside, the intraday moves are really big. But if you guys remember a year ago, I wasn't trading Tesla during all of this. Tesla was just absolute bullcrap to trade. It gave nothing. So I wasn't trading it for like 4 straight months because I knew, even though as much as I love trading it, when to trade and when not to trade it, right? So that's a very important thing to keep a focus on. So what what sectors are really performing well right now? Well, we went over health technology, right? We saw how Eli Lilly, Johnson Johnson has been performing really well. Merck is one of my favorite setups. It's also one of my positions in my long term that I've been loading up on. And also another one that is kind of like the risk on for health sector is Moderna, right? Even if you love it or you hate it, I just could not avoid getting into the setup, right? Because if I start seeing health technology doing well, if I see Johnson Johnson doing well, and I see Moderna, which has been catastrophically selling off since the dinosaurs existed, that means there's eventually going to be a base, right? Because no matter what, Moderna has less of a chance to just completely go away from being on the face of the planet. So that's why it's important to figure out, okay, all right, Moderna's kind of basing right now, and I see how technology doing well. Maybe I could look at Moderna, right? So that's another important thing to look at. If we go back to the stock heat map, we'll see other sectors we might want to keep a focus on. Energy minerals, right? Energy minerals, energy is going to be stocks like XOM. Now, the reason why this is also important to look at is because XOM and a lot of energy stocks have been completely basing for the past 3 years. So if you go look at XOM, it's been basing, right? If we look at CVX, has been somewhat basing. It's kind of in a bearish channel, but theoretically, it's in a base, right? What's the other one that's pretty ass? Sorry, excuse my language.
Oxy.
Oxy, yes. So Oxy, Buffett's favorite stock, right? What has it been doing? Nothing, right? In fact, it's been selling off, and he kept on buying more and more shares. Doesn't mean that these sectors are just completely going to explode in 2026, but these are underperforming sectors that do outperform technology and risk on sectors during consolidation for whenever the tech stocks are consolidating or whenever it's a bear market. So health technology we already saw is catching up steam. Now we want to keep an eye on energy. Is energy going to make a move, right? We see, CVX looks like complete dookie, but XOM on the other hand, even though it doesn't look beautiful, is still kind of the thing that you just want to give a second look to be like, wait, am I imagining things, right? So, you're looking at this, you're like, okay, if this breaks out of here, out of the range high, this has momentum because this has been basing for 3 years straight. So it's very that again, like that's why it's very important to know stock, not stock heat maps, stock rotation. No, let's see other sectors, right? Consumer
Communication
durables.
services.
Oh yeah, JP definitely wanted me to talk about this. So not consumer communications is going to be stocks such as Verizon, AT&T. These are known to have higher dividend yields and very not poor performance, but subpar performance, right? But they're not really safety stocks, but you could somewhat compare them, you could somewhat accept them as more safer than technology during a bear market. So, for example, if you look at Verizon, nothing special about it, but you could see that it's been basing for a year now. Now, if you go to AT&T, I know JP was excited about this one, and he could definitely talk about it in just a few minutes. Um, AT&T is starting to try to find support, right? So, is not technology, is communications also going to pick up steam, right? So, the next question is if we're seeing technology already kind of sizzling off, and the only things that are bringing up technology is a few stocks such as MU and other stocks like that, where's the money moving towards and where could it temporarily be in? And, that could help you either swing trade, that could either help you actually day trade certain stocks, right? If you for example want to trade weeklies and you're seeing health technologies doing well, Eli Lilly might be tough to trade, but Johnson Johnson is a great option chain, right? So that's the whole thing I wanted to bring up about that. And then one thing I don't understand is how UNH is still here, you know, a decade later. When did it crash down? It crashed down in May, right? And this basically was the definition of a IV, like literally a contraction. So it just the ivy completely crushed everything. We've just been going nowhere. So health sector, communications, all of these things are just very important to look at. And a very easy way to look at it is in the stock heat map, or as many times before, you can look at what JP talked about, which is FinViz, and you could look at the groups section that kind of shows you the performance of the sectors in the time during that time, right? But since we're only gonna have 20, probably like 25 minutes left of this live session, because I'm getting pretty tired, and I know JP is pretty tired as well. We're actually gonna talk about briefly about the positions or stocks we're looking at for 2026, whether they're gonna be swing trades or long term. So JP, since I know you wanted to talk about AT&T, why don't you go ahead and actually talk about the stuff you're looking at?
Primarily, and we'll just look at your chart. My top three picks for next year. The first one is Moderna, mRNA. I've been filling this in the 25, 26. I'm already up. I was up 30% for the year from my bottom entry. I'm only up 23% now. I believe in this technology. I think biotech is due for a pop. I really, really like the idea of keeping an eye on this entire sector with CRISPR included. Moderna definitely, I think at $30, 20, 25, 26, 30, anything around here, I think is still a gift. I think we're due for a rotation back into healthcare. It's been beat up. I don't think that growth is gonna be the bomb that everyone thought it was gonna be for 2026. So Moderna, which is still within the technology sector because of its mRNA technology, is one that I'm definitely watching. So we fall back into that biotech healthcare sector. The other one, of course, is communication services, AT&T. I really like AT&T. I like it at around 24, $25. Even at 26, I think it has room up to 28, 29. If it can get above 30, I'd be super happy. Again, this pays a 5% dividend yield. I like the communication services sector because I know that there's going to be a lot of new installations that are being done both by Verizon, T-Mobile, and AT&T for their fiber optic technology. I know at least here in Palm Beach, they're trying to modernize most of the optic. What is it? The optic for the fiber optics, and they've been ripping out all the old stuff. So I think that there's going to be a little bit of expense that that these companies are going to run into, but I think that as they improve their technology, it's only going to get better. And there's only three leaders in that space, right? There's AT&T, there's Verizon, there's T-Mobile,
Do you
and
consider
again,
Meta?
well, I want to look. I want to talk about the infrastructure itself, right?
Okay, gotcha.
The AT&T, Verizon, all of these companies, T-Mobile, they all provide 5G. They all provide fiber optic technology. I like that. I like communication services. Then the other thing that I recently started adding was VDE, which is the Vanguard Energy ETF. Yeah, call me crazy. I don't want to be vested into just one particular
Energy stock.
underlying inside of the ETF or inside of the sector like XOM. So I decided to go into VDE. I like the Vanguard ETFs for the Roth. I my entry I believe is 124.80. I'm okay with holding this and letting it eventually do what it needs to do. Do I think this is going to be a home run? No, but I do want to be in the energy sector and I do want to be diversified. So, as you can see, I'm once again going into the new year trying to be a little bit more defensive and less technology driven because I do think that a lot of these earnings for these technology companies are gonna slow down a little bit just because of the uh, the boom was so big this year that they need to outweigh themselves um, going into 2026. They have to blow things out of the water for those PEs to continue to increase. And the last one is PANW, Palo Alto Networks. I love Palo Alto at anything under $200. I think Palo Alto is a $350, $400 stock. I know people think I'm crazy. I've already begun buying it at 182 and 183. And I continue to add every week a little bit more to my position. I think that cybersecurity is a sector that needs to be paid more attention to. I keep on saying, and I said it before and I'll say it again, I don't believe that wars are going to be fought anymore by soldiers. I think it's all going to be computer warfare, and only a few of these companies are gonna thrive, and it's gonna be companies like CrowdStrike, companies like Palo Alto, companies like Fortinet, and I want to be part of this. If it does pull back down to the 150s, I actually have a level at 152.50. I'll be buying more. I would like to see Palo Alto trading at 300 by the end of this year of 2026. And that's it. Kevin? Baba.
Sorry,
Hey, Bob.
no, sorry, I'm here. I was talking to myself over there. My mic was
Right.
muted. Um,
Oh, I'm so sorry. And I have one last thing that I wanted to bring up, which
okay.
people have a tendency to laugh at. EWZ. I'm so sorry. I don't think you, yeah, there we go. Perfect. This is the, I literally read end the ethnic cleansing in Palestine. I'm like, that's not the ticker. EWZ. This is the Brazilian market ETF, courtesy iShares. There's two regions that I believe going into 2030 are going to be very, very, very important. Number one is Latin America. Um, and the biggest country in Latin America is Brazil. I believe Brazil is one of those undervalued markets that no one really pays attention to, and no one puts into consideration as a contender of as a first world because they're in a third world continent. They produce fruits, vegetables, beef, oil, cattle, leather, flowers. They have every single resource in the world. And I believe that as Latin America starts to change its political footprint like Argentina has, and if the US does overtake Maduro in Venezuela, Brazil will become a power player in the market because of Petrobras, right? It's being one of the biggest oil manufacturer producers in the world and being part of BRICS. And there's also such a huge population of innovators in that country that I would not be surprised if we start to see companies go into Latin America to start to produce things that we really, really want, just because it's easier to get from them than it is to get from China, right? So I wouldn't be surprised if we start to see chips being built in Brazil. I wouldn't be surprised if we start to see more cars being built in Brazil. So I'm keeping an eye on that. And I still haven't found the right ticker for this. And people will laugh at me, but I think that the Middle East will become the new Silicon Valley by 2028. So I'm digging deep into which emerging market ETFs that specifically targets the Middle East is gonna go into my Roth. It's a growing population. It's a smart population. It's a hungry population. And when you put smart, hungry people together, they have a tendency to become very explosive, both in a scientific way and an infrastructure way, similar to what happened in Singapore. So I haven't found the right one yet, but I will find the right Middle East ETF, and that's it. I'm done.
Yeah, well, I'm gonna say same stock I did, not in the beginning of this year, but in the end of last year. and the whole sector, which is freaking Chinese stocks, because I am literally jacked to the tits when it comes to freaking Chinese stocks. I am always in either Baba and Baidu. And before last year, I was definitely more in Baba. But this year, I'm finding myself liking Baidu a lot more than Baba. Not even though Baba has a lot more strength, right? Like it has a stronger overall trend. Baidu, on the other hand, to me, has a lot more cleaner setup, right? So we're both looking at the weekly on both Baba and Baidu, and you can see here that it's a very easy invalidation point kind of trade that you're looking at. What do I mean by that? Well, let's say Baidu doesn't break out of this, this bull flag. Okay, that's invalidated, right? You know, very, very easily. Versus like trying to figure out, okay, where do I enter? When is my invalidation point? Baidu and both Baba have very clean charts, in my opinion, to kind of, burst up to the upside. You can see Baba has been testing its, 52-week highs over and over again twice in the past year. And you could see right now, just like most stocks, is come back and trying to retest the previous high, right, which is around 144, 145. So if Baba holds that, then my next target is all the way up at 220, and then it's even farther up than that. And then Baidu, on the other hand, I feel like has been catching a little bit more steam and momentum. I don't know why I keep on saying steam. More momentum than Baba does in the past few weeks. And I see this. I have my targets all the way up at like 250 for Baidu. And the thing that's, other else on the charts looking great for this, you have to realize like both Baba and Baidu have immense, huge cash reserves. And they're also very fundamentally, even though I didn't dive too deep into it, but you guys could do your own research and you'll kind of see this as well. They're very fundamentally undervalued. So it's just something to keep an eye on. I still have my positions here on Baba and Baidu. I'm up pretty big on Baba, and I'm up on Baidu, because last year, in the beginning of this year, I kept on talking about all my fills near the bottom here for Baidu and Baba. So I'm still even adding more to Baidu up here. I like to average up when I see something strong. I find that a lot more profitable than, for example, averaging down, right? So, yeah, so I definitely averaged up on Baba and Baidu. The other thing I want to talk about, JP talked about the all-time highs on gold and silver, just like in the beginning of the year. Um, Again, we talked about it here before it started squeezing. Gold miners, right? Gold miners are something that I'm also keeping an eye on. You see some companies like OR is starting to pop up and look a lot more bullish. There's OR, there's FNV, there's AES. No, not
Eric
AES.
Mining.
Barrick Mining, right? Thank you, Aiden. Right, all of these companies are performing really, really well. So I've been adding a lot of these also to my swing positions, to my actual long term. I think I even have a watch list. Let me see if I have it of is it in here? Let me see. Of gold mining stocks. Yeah, so this is some of them. This was a list I made in the previous year, and I'll put it in the main chat and also in the VC chat so you guys can have access to it. But if you see here, like there's a bunch of stocks you could go through that's related to both silver and gold. Are these all of them? No, but you could still look through them. Like if you look at AGQ, obviously since silver's been doing well, the ProShares Ultra Silver has just been freaking ballistic. It went from my entry for these was around $52. It went from my entry of $52 to 167.68. That is freaking insane because this is a leveraged version of silver, right? You have FSM, which is, I believe, a mining corporation. It is. So you could even see the silver mining companies are also doing really well. PAAS, it's probably the better of the option chains between these three, has also been doing phenomenal, right? If you go down to gold, even though gold has less volatility and less velocity, you're still seeing it performing really, really well, right? GDX, which is just the basic mining ETF. That's also you might want to keep an eye on. AEM, right? We talked about that. AGI, GFI, AU, FNV, Ego, right? Like these are all companies that are performing really, really well during this time. And remember one thing, right? Trends usually last for a while, right? So if you're still seeing silver and gold performing well and technology not performing that well, you can probably, look at this watch list or make your own watch list of these uh, you know, of these stocks. And someone said that all those charts look the same, and yeah, they look the same. That is what you get in a sector rotation, right? Whenever you go away from a very vast, large sector like technology, you're going to go from, you know, stocks looking a little bit different from each other to stocks looking really, really similar. Like the healthcare, if you look at Eli Lilly, and well, that's too far out. But if you go to Eli Lilly and Johnson Johnson, they're not the exact same, but they're very, very similar, right? So that's why sector rotation is sometimes so profitable where you don't need to catch it. Like you don't need to try to predict what's going to happen. You could just wait for these things to show strength and you could try to catch it on the continuation because this is something you're expecting to last for a while. I can tell you that I've had leaps on Johnson Johnson, Eli Lilly, Ego, FNV. The FNV and Ego are all gold companies, GDX, and they're up tremendously. And I did not try to get like any kind of amazing fill on them. I just got them when I saw that the trend was forming and it was up towards the bull side and the technology companies like Nvidia is starting to kind of slow down a bit and they're up a tremendous amount. Even if you don't do leaps and you do equity, you could do that as well. Or if you just simply want to do swings, right? You could just keep an eye on these stocks and when it gives you a nice setup that you like to enter, you could potentially enter into those. So gold mining, silver mining, especially because if you guys compare SLV, I was talking about this earlier. SLV compared to GLD, I personally like SLV a lot more. I'm not saying that GLD is subpar, but SLV has clearly had a lot more velocity and a lot more momentum to it compared to GLD. Maybe the reason is because GLD did had a really nice squeeze beforehand in the, few months ago versus SLV, even though it did trend upwards, it didn't have as strong as of a squeeze as gold did at the time, right? So probably, you know, people are shifting from gold, which is the leader, to the laggard, which is silver. So something to keep an eye on. Um, Another thing is small caps. So if you actually compare QQQ to IWM kind of seems a lot stronger, right? Because if you look at QQQ, this has been ranging, right? So technology has been ranging since October, right? If you want to, even though it's a pennant, let's just say it's ranging. On the other hand, IWM has, even though it did, go up and it came down, it's coming right back up, right? So it has a lot more strength in the short term or in the near term, right? Obviously, this is because of the rates and the rate cuts and whatever. JP could obviously explain more about that. But as we said before, these companies do very well during rate cuts, right? Or whenever rate cuts are when people predict they're going to happen. So now I would probably want to be also looking at small cap stock companies, right? I think one of them is going to be, for example, Rivian. Rivian is JP. It's a small cap, right? Right. I'm pretty sure it is.
I am lying to you if I tell you that I know it. That's
I
true. I don't know. I
feel
don't know.
like it is. Oh, market cap is 25 billion. I don't know, but you get what I'm trying to say. Like, obviously, the bigger cap stocks are not performing as some of these smaller cap stocks are doing. And talking about smaller cap, another theme that I also have in my long term as well is going to be nuclear. So nuclear, um, especially the SMR stocks, are have been having a lot of momentum, and as of recently, it's been selling off. Now, one
Sorry to
thing
cut you off here, but Rivian is considered a large cap.
it's considered a large cap. Okay, thank you for correcting me. But you could see here that, for example, Oklo has been selling off a little bit, but it's at support right now. So Oklo is something that I'm in, and all the other, nuclear stocks like SMR, GEV, and NNE are stocks I'm going to be looking at, right? So these are things I want to keep a focus on that I already have in my long term. I think the most important part is we're not disqualifying any of the tech companies to be performing good, right? Because AI train is still there. The demand for it is still there from business to business, not really business to consumer as much anymore, but definitely business to business. And that is still leaving a lot of room for, business to business, business, right? Or transactions. And then just profit margins increasing because of all these layoffs. So these tech companies are still going to be here and they're going to trend eventually. But in the meantime, it just seems like even, with everything JP said and everything that we've also seen across the market, these things are kind of losing steam. And there's nothing really saying like, hey, you know, Nvidia right here looks amazing. Like, yeah, it looks good. Maybe we might get a pop here, but then we would know that technology is going to continue to the upside once Nvidia breaks its highs. Because when you're in this kind of situation, one thing you do not want to get trapped into is a lower high, right? Because this is a high, you don't want to get stuck in a lower high. So usually what I usually like doing is waiting for it to break above the previous high, come back and retest somewhere near the all-time high, right? And then bounce off of that. And that's when I know, okay, all right, technology is back in full strength. Maybe I'll start taking my risk from health and I'm going to move it back into technology. So yeah, I mean, even if you trade zero DTEs, yeah, it's very important to know these things. JP did a fantastic job in the beginning talking about how economic data, even though it's been completely shitty, is not really in parallel with what the stock market is doing. And that's why we discussed about the whole part where, it's because the data is not terrible as people expect it to be. And then on top of that, the profit margin for these companies are increasing. Rate cuts are happening, which are bullish for the economy because that means not economy, but for business because that means companies are going to go out and try to borrow more money, which means when they borrow more money, that means either research, innovation, more jobs, et cetera, right? So 2026 is definitely going to be a very interesting year. And, to tie that up, I also did want to mention that we are going to be bringing back live session as a much more active thing. There's going to be a lot more topics, and we're going to continue exactly where we left off. In fact, the next topic that I will end up be doing is most likely a lot of people has been asking me about these ribbons, right? These SMAs. So I'll be going over how I used them, 12 years ago and how I use them today. Things that changed and how I make trades according to them today as well. Then some future topics that I'll be discussing is, price action, how I trade price action. A lot of people are interested in how I trade SPX. A lot of people are also interested in how JP trades SPY and the EES, even though he recently talked about that. So there's a lot more things we're going to talk about. But before we head out, uh, do you guys have any questions? And while you guys put down your questions, JP, was there anything you wanted to add?
Yeah, I wanted you. I wanted. I know that you're going to ask me why am I looking at emerging markets. I want you to look at a chart. It's AFK. Zoom out.
Yeah.
See how these are the things that make me nervous. This is the VanEck Africa Index ETF. It has very low volume at 27,000 shares, traded. But these are the things that make you think. There's no reason for this to go up unless something is happening on a global geopolitical and economic level that we haven't been paying attention to, right? I mean, if you look at it from where it opened this year, trading at $15, right? Or I think it was even less. Where did it open in January? Yeah, whatever, somewhere about $15 to now almost at $30. It's 100%. You know,
Yeah.
it's doubled. Not 100%, but it's doubled in price, and these are the things that I'm watching in these emerging markets that might make me like look at IZRL. This is the ARC Innovation Israel Innovative Technology. Another up and to the right chart. Look at EZA. And that'll be my last one. That's South Africa. Emerging markets are doing something. And I want to ride the wave when it swings over to Latin America. So that's why I'm looking at Brazil, if that makes any sense.
Yeah,
If
sure.
if that justifies anything as to why I'm so bullish on emerging markets.
Cool. All right. Yeah. I think that basically sums it up. I'll leave a minute for questions. You guys can ask whatever you want, and if not, we will end it here, and I'll be busy till almost January 6th, so I won't have a live session until afterwards, but there's definitely a lot of topics that we can cover. And this was recorded, so we'll see. As long as the recording is not corrupted, it should be uploaded to YouTube by tomorrow or Saturday, so that will be definitely up. The space sector, I think, is definitely there. I just feel like that's a sector that will heavily benefit off of a very risk-on environment. And that was probably the case, like, probably a few months ago. One of the stocks that I like when it comes to space is like ASTS, for example. And it was looking really bullish, and it had this huge rejection on Christmas Eve, right? So it's something to keep an eye on. I'm still bullish in it, about it. But I feel like a lot of other sectors are going to be catching a little bit more momentum unless I start seeing ASTS kind of get back above the highs of this major rejection candle. That's when I think I'll continue to be very bullish on ASTS. And then that's an easy, in my opinion, a target of like 150 all the way up to 215. So when it comes to space stocks, I really like ASTS. So ASTS is the space stock I'm looking at. VXUS. Vanguard Total International Stock ETF. Yeah, I'm not surprised. I mean, if you also remember, like the whole thing before the whole tariff and Trump's whiteboard, Trump's special little whiteboard when he came out with it, like there was a lot of money that was flowing during that time towards international, what's it called? Equity, right? Or whatever. So I'm not really surprised that all of this kind of is just going to the upside, whatever JP talked about and what you brought up right here with VXUS. So it's definitely interesting to see, but it's also very, very reasonable as to why it's happening, I guess you could
If
say.
anyone's going to get into one particular emerging market ETF, like, I mean, if you just want to play it safe, you can always buy the VWO, which is the Vanguard Emerging Markets ETF. I think it's like $54, $53. That's always the safest bet to go, right? Because if anyone's going to be diversified inside of a sector, it's going to be the Vanguard. The only problem is that you have to take into consideration that Vanguard, even though it is an emerging market ETF, it's heavily weighted to China as opposed to a broader sector. That's why you almost have to like pick one ETF in one market and hope that you're on the right side, right? Because if not, you're just going to be China dependent.
All right, cool. I think we're going to call it wraps.
Yeah, I'm done.
Yeah, it's a pleasure talking to you guys. Good
right,
to be
brother.
back on
Talk to you
after a
soon.
while. All right, thank you, JP.
All right,
See you guys
catch you later, guys.
Peace.
Bye.
Good night. Look forward to next time.